Hello and welcome to the Passive Pulse series where we discuss passive funds and ETFs. In this program, we try to explain how these investment options can strengthen your portfolio and enhance your returns. In today's episode, we'll talk about broad based index funds. So let's begin the journey into the world of passive investing only with Passive Pulse. And joining me now is Mr. Arun Sundaresan. He's head ETF at Nippon India Mutual Fund. Welcome to the show, Arun.
Thank you, Gitu. Thanks for having me on the show.
Arun, let's first start with the basic concept of broad-based index funds. What exactly are broad-based index funds and how do they function within the market setup?
So, as far as equity indices are concerned, there are four types of equity indices. One is a broad market index, second is sectoral, third is thematic, and the fourth one is called strategic. So, you asked about broad-based indices. Essentially, these indices are what are commonly known to everyone, like the indices like Sensex, Nifty, mid cap, small cap, and there are, of course, few other broad-based indices. All these indices are market cap based, meaning
Right.
the large within each part of the index. Suppose you take Nifty 50. So here we are talking about the top 50 stocks in terms of free float, in terms of market capitalization, in terms of
Correct.
size, right? So likewise, if you take mid cap, we're talking about 150 stocks. That is from stock number 101 to 250. So that is defined as mid cap. So then it becomes a mid cap index. So that's also part of the broad-based indices. So essentially, we're talking about these indices: large cap, mid cap, small cap, large and mid cap, Sensex, Nifty, next 50 of Nifty. All these are part of broad market indices. Essentially, they are market cap based.
Okay.
So the largest stock within each index will have higher weight. Like if you take mid cap or small cap, so we have, let's say, 150 stocks in mid cap. It will not be equally weighted. The largest stock will have a higher weight. The next stock will have slightly less, and it will keep going as per the size of each of those stocks. So that is what is called as broad market indices.
What is the key differentiator between the Nifty index, like we have Nifty 50 index, and a broad-based index? What are the key features that we should know before investing in broad-based index funds?
So Nifty 50 is one of the broad-based indices. So like I said, Nifty 50, Nifty Next 50, Sensex, BSE 100, mid cap, small cap, all these are part of broad market indices. So Nifty 50 is one of them. So Nifty 50 consists of the top 50 stocks, again weighted as per market cap, but it is just one of the several broad-based market indices that are available. Now, what do investors need to keep in mind? Obviously, each of these indices represent different parts of the market. Like Nifty 50 is part of large cap. In fact, it's a subset of large cap. So large cap is defined as the top 100 stocks. So Nifty 50 is only 50 out of that, right? So that is one part of the market. Likewise, you have mid cap, you have small cap. Each of these indices, the characteristics, the risk return profile would vary, right? And they might work at different points in time. Like, for example, there is no thumb rule, but in general, mid cap and small cap parts of the market are said to be more aggressive on the potential for risk and return. A large cap, relatively speaking, people associate large cap investing with reasonably consistent return. Maybe it could be slightly on the lower side when compared to mid cap and small cap, but they are different. So each of them come with their own characteristics. Investors need to understand that, and based on their risk appetite, and sometimes based on their view. For example, if you have a view saying that within the market, I expect the mid cap and small caps to do well, you can choose those type of indices and those type of funds. On the other hand, if you say that look, I want to be in equity, but within that, I want to be slightly conservative. Let me choose and be in the large part of the large cap part of the market, maybe in Sensex or Nifty. So accordingly, the risk return, the potential, all of that will vary.
So what I understand is that it all depends upon the risk profile of the individual who really wants to get into all these funds. But how does it help to diversify one's portfolio? Because investors have become quite aware, and they are not invested in one or two funds. So they make a portfolio, a bunch of funds. So how will broad-based index funds really help them diversify their portfolio and manage their risks?
So all these broad market indices are fairly diversified. So even if you take Nifty 50, so we're talking about 15 different sectors. So you have 50 stocks coming from across 15 different sectors. So that's the key difference. So unlike other types of indices, I did mention that there are 4 types of indices.
Right.
One of them is sectoral. The other one is thematic. So those could be considered to be very specific. They focus on a specific theme or a specific sector. Unlike those type of indices, these broad market indices are fairly diversified in terms of sector. So basically, you get to invest into banks, you get to invest into automobiles, you get to invest into industrial companies, you get to invest into pharmaceuticals. To that extent, they are fairly diversified. So diversification is not really a concern when people actually opt for the broad market indices. But then again, should you choose Nifty or should you go for mid cap, small cap? What is the market context? What is likely to work well at a point in time? Those are things that investors may want to reflect upon before deciding where exactly to invest and how much to invest into them.
So how often are the portfolio, how often are the stocks that are in these indices being reviewed? Because markets are too volatile. So is that that the review happens every quarterly basis or biannual basis?
Yeah, so each strategy would have a different rebalancing period. In general, the rebalancing period tends to be once in 6 months, which I'm sure you will agree with me is a reasonably good time. So equity investment per se is meant for the longer term. So generally we say it should be for 3 years, 4, 5 years, if not more. And given that kind of a long time horizon, which is generally recommended, a portfolio which gets reviewed and gets rebalanced once in 6 months, which means over a period of 3 years, you will have 6 rebalancing. That's fair enough. And in each of those rebalancing, based on the architecture, based on the rules on which that particular index has been built, like for example, if it is a market cap and if this index consists of the top 50 stocks, so in every review, what are those top stocks that will be reviewed, and based on that, a few stocks might move out of the index, a few stocks could come in, and so on and so forth. So at any point in time, especially after the review, the indices will be true to label. So if you say this is a mid cap index consisting of 150 stocks, at the time of rebalance, those 150 stocks which fulfill those criteria, they will be part of the index and the other stocks will move out. So, but then this is in general 6 months. There are a few strategies which could be having a different frequency as well. Maybe once in a quarter. Some strategies undergo rebalancing once in a year, but broadly, most of the strategies undergo change once in 6 months.
Arun, when the markets are volatile and you have the external factors playing on your markets, so what will the right strategy be? How to identify a broad-based index fund so as the risk is limited?
So it's a extremely difficult decision or choice to make at any point in time. It's not that today the market is like this, therefore there is difficulty. At any point in time, there will always be multiple variables at play. So it's a very difficult proposition to figure out which part of the market is likely to do well. If the market itself is likely to do well, is there going to be a correction? All of these things are very difficult to preempt, very difficult to take decisions on at any point in time, and that's what makes investing very interesting, and that is what keeps a lot of these experts quite busy and occupied. So yeah, having said that, while there are multiple moving components, different things keep happening. The best way to do, people talk about asset allocation. So how much to invest into equity, debt, how much to keep in cash, etc. It is said, a lot of studies have pointed out that this asset allocation decision is something key. In fact, that is what is going to determine a lot of your returns in the longer term. So based on individual risk appetite, someone can decide to invest 70%, 80% in equity. Someone else could decide, no, I cannot have so much equity, maybe 60%. So those decisions can be made. That should be the starting point. So that again will depend on individual circumstances, the individual risk return appetite, right? Now, having selected so much in equity, then the next question is again, out of that, how much to invest into maybe large cap, how much to invest into mid cap, small caps, etc. Again, in general, the mid caps and small caps are considered to be more on the potential for return. At the same time, they carry higher risk. So someone even within equity wants to play it aggressively can choose to have more mid caps and small caps, and vice versa. So that decision again can be made, and then within that specific funds, specific strategies, etc. Can come later on. So again, there is no thumb rule which will say that okay, this is the percentage, and this is how exactly somebody has to go about it. It depends on one, their risk appetite, their unique circumstances, and to some extent reading of market conditions as well.
So, Arun, what are the main risk factors associated with broad-based indices?
See, equity products, equity markets per se carry a lot of risk, right? So you cannot shy away from that. So any form of equity you invest, it comes with its own set of risks. Only that the relative risk, depending on the type of the product, like explained, between a large cap to a mid cap, small cap, and given the context of the market. For example, in the last 2-3 years, markets have been doing very well. And relatively speaking, the mid caps and small caps from a valuation perspective, when compared to large caps, could be more expensive. So all these variables at various point in time can be looked at to figure out, which is relatively more attractive, which is from a valuation perspective, relatively looking better, and so on and so forth. So accordingly, at the margin, investors can make decisions in the sense that something can be a little more, something can be a little less. So those decisions can be made. But having said that, one needs to understand that equities per se come with what we call as the systematic risk. So those things cannot be wished away. The market risk, right? If market goes down, most likely all different types of market strategies, the indices will go down. Large cap also will go down, your mid cap also will go down. So those are things that investors need to understand, therefore have the appetite to hold on. And that's why we recommend that you need to have the wherewithal, you need to have the appetite to withstand those times and not worry about it, which is why we say that please keep a long-term perspective in mind, so that if something like that happens, you are able to ride that out, and in the long term you are able to compensate for any short-run underperformance, and you're able to make money. So that's how I'd like to put it.
That's it. Arun, thank you so much for your time and explaining us what the broad-based indices are and what factors do we need to keep in mind before investing in these funds. Thank you so much for your time, Arun.
Thank you very much.
And with that, we wrap today's episode of Passive Pulse. We hope you now have a better understanding of broad-based index funds and how they can be a powerful tool in your investment journey. Thank you so much for watching.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.